This is Blane Markham, Chief Trading Strategist, coming to you with my weekly market update, breaking down for you what myself and the team are seeing in the market, to what we think that you should be paying attention to right now. So with that, let's go ahead and hop into the charts, because the market is certainly starting to give some signs, some unsteadiness, a little bit of unease. So let's go ahead and break down what's happening in the technical picture. So here we have a chart of the S&P 500 pulled up. So you can see, obviously, very clearly showing the negative price action we started to see here over the past couple of weeks, continuing to push to the downside. So as we've clearly laid out in prior weeks, if you caught our recent market updates, we've been talking about how at first, the levels of resistance above the market kept dropping down, and we kept seeing the market continue to struggle with lower and lower resistance levels, starting to kick off this series of lower lows and lower highs that we really started to begin, roughly in the beginning to middle part of February, and it's continued on thus far through the month here in March. So at first, we saw the index starting to struggle with our 50-day moving average. That's our red line right up here. Then, of course, we started to see this middle counter channel. All that is a 20-day EMA. That has now become a very clear level of overhead resistance for the market. You can see really ever dating back to midway through February, the index, the S&P, has really struggled to actually trade up above that in any meaningful way and have any confirmation above that level. There was a brief spike right here, but ever since then, you see it traded right back down, and every time it trades up against that 20-day EMA there, continues to bump its head, signaling a very firm level of overhead resistance and continuing to put pressure to the downside on this index. Now, of course, I'm sitting here recording this market update here on Wednesday following the market close, and we continue to see the markets decline here in the Wednesday session. Of course, we're still not really seeing much abatement with some of the headwinds that are facing the markets. We're continuing to see interest rates rise. We're continuing to see the price of energy rise, seeing volatility rise. Of course, that's continuing to be a very tough mix for stocks. We also had a Fed meeting today, and while it was largely expected the Fed was not going to make any updates to their policy decisions, there, of course, was the Fed press conference afterward, and during that press conference, Fed Chair Powell took a pretty notably hawkish tone, which led to a further spike in Treasury yields, again putting additional pressure on the equities to the downside. So that led to all four of the major U.S. indexes finishing just right near their lows of the session. Now, to zoom in a little bit closer here, just to the action of just the past week, of course, we did have a pretty decisively negative week last week. It was down 4 out of the 5 trading sessions. We had a pretty significant sell-off on Thursday and Friday of last week, so we continued to have that pressure through the back end of last week since the previous market update that I was able to do. But with that session on last Friday, we did get down to a shorter term, slightly oversold level. You can see that showing up here with our 5-day RSI, showing that it dropped below a level of 30, actually got down to all the way below the level of 20. So that was signaling, at least in the short term, kind of coming into this week here, the setup really was that we had gotten, at least in the short term, a little oversold. We're due for a bit of a relief rally. That's fully what we were expecting, because that's what our technicals here on our charts were telling us. And of course, that's exactly what we got in the Monday and Tuesday sessions. It wasn't extremely bullish trading. Even though we had 2 consecutive up days, we were certainly thinking that's all that those 2 trading days were simply just a bit of a proverbial dead cat bounce, the oversold bounce, because that's where the market really had gotten there in the short term. But again, you can see it really was just not too impressive with trading on Monday and Tuesday. As you can see, the indexes rallied up during the day and then faded towards the end of the trading day. Monday closed about midway through the trading day's range. And then Tuesday, we had a very unimpressive trading day as we, again, rallied up throughout the day and sunk all the way down to session lows. Again, closed up on the day, but still closed near session lows, which signals that there was very little investor appetite to continue to buy up the market at those higher prices. So that signaled a classic candle that we always look out for potential reversal days, which this here was a bearish or inverted hammer here. And when we see that, that's typically going to tell us that we're going to be looking for a reversal of the current day's price action. It's exactly what we got in the Wednesday session. We saw several things that were alluding to that we were likely to see a resumption of the downtrend in the Wednesday session. Of course, that is exactly what we got. In fact, it was just an oversold bounce that we got on Monday and Tuesday. And given that the S&P 500 closed near its lows of the day on Wednesday, that closing low was just a touch below the closing low dating back to last Friday. So that is actually a brand new closing low for the year, and actually the lowest close dating back to November of last year. Now, of course, one really important thing to note here is you can see our upward sloping green line. This is something I've been talking about in depth for several weeks now. This green line is our 200-day moving average. And of course, this is a really, really important technical trend line to watch. This is one of the most widely tracked metrics to determine whether a stock or an index is in a confirmed long-term uptrend. Of course, you need to have the index trading above that 200-day moving average to confirm that it is in a confirmed uptrend. You can see we've been in that relationship with it ever since coming out of the April lows of last year. You can see the index popped above the 200-day in May and has remained solidly above the 200-day moving average ever since then. But now, with the recent trajectory of the index starting to angle down, you're seeing the 200-day moving average starting to slope up pretty sharply. I mentioned several weeks back that it looked like these two were on a collision course with one another, and here we are. We actually had the S&P 500 index close less than 10 points above the 200-day moving average, which is now clearly setting us up for a test of this key technical level. And so there's certainly a lot of trading to go throughout the rest of this week. I fully expect the markets to be contending sharply with this very key level of support below the markets. And it's going to be very important that we see the index hang on to this 200-day moving average. If we're not able to close above it and remain above this 200-day moving average, that could signal a potential deeper correction on the horizon. So we're going to be watching how the index trades around this 200-day moving average to close out the rest of the week very, very closely. That's going to be a very key technical level. And below that, we also do have several other key technical levels of support that we're watching closely as well. Now, one of those is going to be dating back to that November low here. You can see that's just a touch below 65.50, call it 65.40 right here. That was that closing low from the low during that November correction of last year. That's obviously going to be a key level of technical support below this market we're going to be watching as well. But, if you start to see the market trade through that level, which, certainly is possible, it's really not all that far away, we will then start turning our focus down a little bit further down here to the 63.50 or possibly even 6,300 level for next levels of potential support below the market. Of course, back in January, we traded up roughly to about 7,000 on the S&P. So, from that intraday level there, about 7,000, a 10% correction would put us at 6,300 on the S&P. So that is certainly well within the realm of possibility, seeing the index trade all the way down to 6,300 here in the months to come. But with the current price action here on the index, we're fully anticipating that there is some further downside to go. Again, we're going to be watching things very closely because, of course, we have to pay attention to the charts and our technicals. But with the current price action, this very clear series of lower lows and lower highs, having a new year-to-date and 3-month closing low here today on the index, we're certainly anticipating some further moves to the downside here across the U.S. indexes. Now, with that said, we are still continuing to spot a lot of great opportunities out there, both to the upside, to the downside, and also with some of our other strategies like our weekend winners that aim to capitalize on stocks that are consolidating and kind of trading stuck sideways and neutral. But I'm going to go ahead and share with you one of those opportunities where we're continuing to spot some great trade setups to the downside that we can play using some strategic option setups. So to give you an idea of where we're turning our focus to spot some of these great bearish opportunities in the market right now, I'm going to show you this chart first because this really illustrates what we're targeting here. Anytime we're looking to target a setup, whether bullish or bearish on a stock or ETF that is trending up or down, we're looking to place trades on things that have strong relative strength or weakness compared to the overall market. And so here, what you're looking at here is a price chart that is comparing the overall performance of the S&P 500 index, that's going to be our blue line up here, to that of the XLF. This is the Spider Sector Financial ETF. This is the XLF. That's our black line here. And so, of course, looking back over the past 3 months, you can see that for much of this period of time, our blue line up here, the S&P 500, was marginally positive, but roughly trading about flat up until just several weeks ago, earlier on in March, when the performance actually turned negative for the S&P 500 index as we continue to see that downside price action. But you can see here with the XLF ETF, the financial sector, it's been under pressure for a much longer period of time. You can see it was actually back in January of this year where you can see the XLF actually turn negative, is continuing making the series of lower lows and lower highs regarding its overall performance over the past 3 months. So you can see that over this period that we're looking at here, the XLF, the financial sector, has been significantly underperforming the overall index. So this is one of those areas of acute weakness in the market that, of course, we could look to capitalize on by placing some bearish trades on some financial stocks. So we've been watching this trend very, very closely. Of course, we've been spotting some great opportunities out there. And so I'm going to go ahead and share with you next one of those exact opportunities that we have spotted for ETA Trade Alert service members here recently. So it's this one right here. The ticker is AFRM. This is for Affirm Holdings. This is one of the major providers of buy now, pay later sales processing services. And so you can see last year, Affirm, it actually peaked in September of last year. And ever since then, the stock has continued to make this longer term series of lower lows and lower highs. You can see right here, our trend lines actually inverted and went from previously what was the buy signal here. You can see our 21-day dip below our 63-day EMA for a brief sell signal here. The stock tried to kind of get up off the mat here and recover, ultimately ended up failing right around the level of 84, and then took a sharp leg lower here really since mid-January and has been under significant pressure ever since then. You can see clearly our trend lines reverted back to a sell signal here, as you can see the 21-day being below our 63-day right here. So you can see the very powerful series of lower lows and lower highs that Affirm stocks is making here just recently. And actually, just several weeks ago, you can see as the stock was trading down here, see the stock actually traded down intraday and made a new 9-month low intraday here. And so right along in there was when this stock actually landed on our radar, and it was one that we were watching very closely for potential new trade opportunities. But at that time, of course, we knew that in the short term, Affirm looked like it was a little bit extended to the downside. We were waiting for the stock to recover a little bit up to the middle counter channel, allowing it to get out of that short-term oversold status before we look to go ahead and put on any bearish positions for Affirm. Now, of course, you can see in a subsequent trading days, that's exactly what the stock did. It did recover from that short-term oversold state, traded right back up to the middle counter channel, ultimately ended up failing. It found very stiff resistance right at that level and has ever since then. You can see it's failed at the middle counter channel roughly on numerous occasions ever since it traded back up to it. But it was right around in here we actually sent an alert to our ETA Trade Alert service members. And the alert was to go ahead and purchase in-the-money puts on Affirm, anticipating that the stock was going to continue to trade to the downside. And you can see our thesis on the trade did, in fact, end up working out exactly as we thought that it would. In short order, Affirm did continue to move lower, continue to run to that overhead resistance, making a new series of lower lows and lower highs. And in fact, actually in today's trading session on Wednesday, you can see the stock had a massive intraday reversal and actually ended up finishing the day down more than 6.5%, setting a new 9-month closing low. So over the past 3 quarters, today's low that it closed at is actually a new closing low for the past 3 quarters. So it certainly looks like this trend is continuing to move to the downside. And of course, the trade alert that we sent out to our ETA members is continuing to perform quite well. We have actually taken some partial profits along the way, but we are still holding on to the majority of this position here still. And as of the market close on Wednesday, that put option alert for Affirm is currently sitting on an open trade profit opportunity of just about 43%. And again, that is after just a couple weeks of hold time for that trade alert. So certainly hope that you were able to follow along with that trade alert for Affirm. If you were not able to, it's totally okay. Just go ahead and reach out to the FFR team. Go ahead and call into the FFR trading office. Speak to Michael and the team. They're a great team. Please feel free to ask them anything you want to about the trade alert service, about the strategies. But most importantly, when you go ahead and talk to them, they can go ahead and make sure that you are signed up to begin receiving these ETA trade alerts, just like the one I share with you here for Affirm. And we're continuing to spot these great opportunities here in the market. So if you want to begin receiving these alerts, go ahead and give the team a call today. Now, with that said, that's just about everything I wanted to cover for this week's weekly market update. A couple things to be paying attention to. Now that we have the Fed meeting from today out of the way, that's in the rearview mirror. That was a market catalyst that we were watching out for. But, now looking at the horizon, there's really not too many major economic reports. There's not too many earnings reports that are coming up that really have the sway that could potentially swing price action in a major way. Just looking at the next couple of weeks, we're really going to be absent that type of a catalyst for the market. So, seemingly it's going to be markets going to be leaning back on the technicals probably in a pretty heavy way, looking at flow data, looking at the headlines that are coming in, probably ultimately getting back to a very headline-driven market, much like what we've seen here in the past couple of weeks. And until we start to improve some of these headwinds that are currently facing the market and get some positive headlines that start to fall in favor of the market, ultimately, I think we probably are setting up for some additional downside across the markets. So we're going to be watching it very closely, of course, here at the team. There's a lot that we're always tracking. We're paying attention to it very closely so we can keep spotting these great opportunities, just like the one I share with you here today. But again, thank you so much for tuning into this week's weekly market update. I hope you enjoyed watching it. I look forward to putting this together for you next week. But until then, I hope you all have a great rest of your week and weekend. Happy trading to you, and I'll see you back around here soon.